Hello and welcome to Class Solutions Dental Education Podcast, the podcast series where we share knowledge and experience to provide value to you and your dental practice. I'm your host, Phil Cole, and in today's episode, we're going to be talking about healthcare banking. We want to give you a dental specific perspective on what types of banks you should consider and why. And so today I'm joined by Rob Borcherding of Panacea Financial, who'll be sharing his thoughts and experience. So, hello, Rob, to the podcast. Welcome. And
Thanks, Phil.
so tell us a little bit about yourself. I mean, you got quite a bit of experience and stuff. I've been working with you now. When you went over to Panacea, you guys have been doing a great job. So just give us a little bit about yourself.
So I've been in banking and lending since coming out of college actually. So I was with another big bank for 22 years, in various capacities, consumer lending, like actual just regular banking, retail banking, credit card processing, and then practice finance. So over my tenure with my former employer, a lot of different experience across consumer and business and other retail banking operations on top of the practice lending that I ended up at. A couple years ago now, actually 2 years ago over Labor Day, actually, I joined Panacea. And Phil, as Panacea is a bank that was founded by a couple of physicians who wanted to change the way that banking and lending works, specifically to doctors. So our motto is kind of for doctors by doctors.
Yeah.
So with that, I saw it as an opportunity to kind of take my skills to help a very specific bank. And it's been fun. The last couple of years have been great. So yeah, I've really enjoyed the change. And as you know, we're just it's a fun thing when you have people that come from these industries wanting to change something, and then you have a different philosophy inside the culture that then allows you to kind of do things a little bit more uniquely, is what I
Yeah.
would say.
No,
Yep.
absolutely. So, doing banking for quite some time, and of course we still revert back to the old COVID days and stuff like that. I mean, there's a lot that has changed in healthcare over the last 2 decades, and so just give us a little bit of a background on, I mean, especially like you said, with your years of experience, kind of what has evolved over the last couple decades.
Yeah, and I mean, I'll be the first to admit, Phil, also there's been people around in this industry, for 20 years longer than I have, right? So I mean, the practice lending, I guess history of practice lending, I should say, really kind of started, back in the 90s, the formation of a couple very specific lenders that, before then, there just wasn't necessarily a dental or a healthcare specific focus, where you have a specific credit policy, and I'll get to that in a second. So really, what kind of changed and morphed over the last 20 or 30 years or so is that people in banking institutions started to realize the ultimate risk with these industries. Dental, veterinarian, optometry, physician, private practice lending, where they saw like, hey, these types of businesses don't have the same risk as a engineering firm, an auto body shop, a restaurant, and so what happened is that you had this natural evolution of policies that then became specific to the nature of the risk, right? Whether that being uh, no covenants, better pricing, faster turn times, whatever it may have been for that specific lending institution. So basically, the bank policies got changed and the guidelines got changed to accommodate for these industries, right? Because again, people throw statistics out all the time about, well, how many dental practices actually fail, how many vet practices actually fail. I mean, obviously there's still practices that don't make it, but when you look at them compared to other industries, it's more. I mean, we always say they are recession resistant, right? Not
Yeah.
recession proof, right? There's still ups and downs in these types of industries, but basically what happened is that these banks over the period of time created these niches and these credit policies and these credit programs that were specific to a doctor owning and operating a private practice, right? And you have to be a doctor to qualify, right? So if a nurse practitioner or if a vet tech or a practice manager wants to start a practice, it's not the same. It was founded around owner operator, right? The doctor is in the practice, they're doing things themselves, they're controlling the patient care, they're controlling the practice, and with that, um, the risk is lower, right? Because they have everything invested in their future. Um, so as more and more experience and more data, kind of came out with how these loans performed, you keep seeing an evolution, right?
Right.
You keep seeing an evolution of guidelines on specific components to these loans and these programs. The basics are still there, right? Like you still have, a debt service coverage ratio, right? The practice has to cover the debt plus a cushion, right? You still have, hey, the applicant has to have a minimum FICO score of X, right? Depending on the lending institution. But what's ultimately changed, as you know, Phil, is like this term that's thrown out in banking all the time in lending for these practices, loan to revenue, right? Or loan to
Right.
gross annual revenue. What used to be 70% of gross collections or gross revenue went to 80, and then it went to 85, and then 90, and now you have some lending institutions out there that'll go to 100 or even higher. So what you've seen is that lenders have continually stretched as more data comes out on what makes a loan go bad, or what makes a doctor's character cause a loan to go bad if the practice isn't successful. um and it's just evolved, right? It's just evolved, just like the industry. Liquidity is another one, right? Hey, a doctor has to have X amount in the bank to qualify for X amount on the loan.
Right.
And there used to be hard lines, and all these things have kind of just evolved, right? There's been a natural evolution of the more data you have to back up a decision, and the more just emphasis you have on these specific programs, and then you look backward, you're like, oh, those loans are okay, right? Well, what if you stretch a little further? Our chief credit officer, Rich Fortino, I mean, he was at PNC Healthcare Lending, TD Healthcare Lending, Citibank Healthcare Lending. So when you have 20, 25 years experience, on watching these loans, mature and either do well or underperform, I mean, that's kind of where all these policies come up, is people like Rich, and other people in our industry just know it now because they've been doing it for 20, 30 years. So
But I
that's
think
that's probably, yeah.
well, I was just gonna say, I think the other thing though that has, and the years that I've been, involved in and stuff, which, hasn't been as long as you, but, uh, you know, what I've noticed though too is how the cash flow debt services has become almost the key proponent, right? If there's enough there for a bank, then that kind of is dictating the size or the percentage of the loan too. Because I know when before COVID, man, everybody was pushing that 100% value stuff. COVID hit, and then I don't know how many bankers I talked to or lenders at that time were like, yeah, we are nervous, we've got to reset ourselves, and everything kind of went back to 2020 of the we're paying 70 to 80%, or 60 to 80%, we're not going over 80, and so you just start telling people that. But once again, it's just kind of funny because when almost every dentist rebounded from COVID,
Mhm.
that was the big worry, will they rebound, blah blah blah. And when they did, several different ways, but when they did, I noticed that we're getting right back to that thing where each bank, especially with interest rates, um, now I see where banks are throwing like, well, we're going to go 5% higher than any other bank, and it seems to be like, instead of interest rates now, it's how much will we give them to try to beat out the other competition. Am I wrong, or uh, I just, that it keeps creeping, and it's like, when will it stop?
Yeah, like there's a couple couple points in there. First of all, like, well, yeah, I mean, if you look backwards, you have the recession, the Great Recession from '07 basically to 2013, right? So,
Yep.
so the lenders that were out there, Bank of America, Wells Fargo, as an example, I mean, they had, millions of dollars in their portfolio, and they learned, what happened during that period of time with, the housing crisis and the recession, et cetera, right? And then they saw this many, loans went bad, this many, but man, a lot of doctors did fine, right? I mean, obviously there was a lot of issues at that time, and then we were buzzing through the 2013 to 2020, and then the pandemic hits, right? And there's another new experience that tests the portfolio of all these lenders that had millions, if not billions of dollars of practice lending on their books. And then we see the rebound in 2021, and now we just got through 2022, and now we're almost through. So yeah, like every year that goes by, and every I guess economic event, triggers a testing on the portfolio, which then everybody learns from, and then you have that experience written into your portfolio and into your mind on how to make the decisions for the next one, right? So like it's
So the risk becomes less and less, basically, is what you're saying, because of the fact that the stats show that we made it, that made it through this, we made it through that, and so forth, is really what you're saying, right?
I mean, just the risk appetite for any lender gets tested with each one of these economic events, right? So,
Right.
whoever the portfolio was through the COVID pandemic, I mean, they now have a very significant economic impact where you were forced to close for 2 months and just do emergency procedures,
Right.
right? And then, man, that like everybody did, basically a 90-day deferral when March hit in 2020, because nobody knew what was going to happen. And then, things happen with whether it be the PPP loans or the kind of like what we call the lag. So people, the rush to come to bounce back, right? In 2021, everyone came back in for those. Like there's just so many things that happened during that period of time that tested each bank's portfolio, and the credit officers of each lending institution then learned from that, analyzed it, and then are using that to make decisions on today, right?
Right.
Um, Now, the other thing you're talking about there is just the inherent nature of practice lending, which is blue sky, right? Like if you're doing a loan for a dentist and they're buying a practice for $1 million that's doing 1.1 million in collections or whatever, for whatever reason, I mean, what's the bank's collateral for that? I mean,
Right.
used equipment and ARs. So I mean, you guys do transitions, right? I mean, when you're selling that practice for $1 million and you're doing your valuation, there's goodwill and there's hard assets. And I mean, if that loan goes bad, like what is that bank gonna even be able to grab and resell,
Right.
right? So blue sky lending then, where versus a manufacturing company that has, millions or hundreds of thousands of dollars in equipment that you can collateralize to make a decision on, and you can always take that back. I mean, that's kind of where things evolved, right? When you saw
Right.
the collateral based lending versus what we consider more cash flow based lending, which is lending to blue sky, because it's all about what the doctor will make to cover the loan, not what assets you could take to
Right.
cover the loan,
Right.
right? And so that leads into, your last point you were just talking about, which is, yeah, like cash flow is king when it comes to supporting a doctor buying a practice or whatever they might be doing, expanding their practice. And so as these practices cash flow, and as you look at the transition plan, what the buyer can do versus the seller, if the seller's staying, I mean, all those things that go into a business transition,
Right.
as long as the cash flow continues and the price can be substantiated when it comes to acquisition lending. I mean, yeah, like again, cash flow has always been king, and
Right.
and that's kind of how all of us in the industry, continue to make these decisions and look at the risk,
Well,
right?
I think that if more than anything, the most important thing is any sellers that are listening to the podcast today is so important to what has just been discussed so far, to understand how to make sure that you have good books showing good cash flow. Instead of, we just ran into a dentist that 15 years of, loss on their practice. Not saying they can't sell it. It's just a case in point. We got to do a lot of work backing that out and everything. And it does show to a buyer the perception of this isn't a very well run practice. Or the guys that, like I said, are should, running. We have one right now in one of our states that we're working with 90% overhead. That's just it's a tough sale, right? That's a tough thing to go over. And so getting those things cleaned up is a big deal. So another personal experience that just came across my desk last week. Have a buyer that wants to buy into a partnership practice and stuff, and I was letting them know that they should, first let's get banking taken care of, right? I mean, there's just no sense of. I don't know how many times I run across buyers and they haven't even talked to a bank yet, but they want to buy a $1.5 million practice. So in this situation, the buyer said to me that, I've talked to two national banks. But then I said, okay, so who's the bankers that you talked to? And they gave me names that I wasn't familiar with. And I said, okay, I'm not familiar with them. And how did you get their names? Well, I called the national hotline, they said, and they gave me these two. Come to find out, they're bank branches in this. And so my always thing is I like dealing with with banks that are more national based healthcare lending specific banks and stuff like that. But the buyer says to me, well, is that a problem? I don't know if it's necessarily a problem, but yet on the other hand, with your experience, what is the difference between a national bank, then you have these regional banks, but then you have like literally like, First State Bank that's, in Midland, Michigan here, that's just a local bank that has 5 branches. So what's the difference between those for a buyer going to get a loan?
Yeah. Yeah. So, kind of getting back to the evolution, I mean, what you'll basically like my advice to any doctor, physician that's, looking into practice lending for whatever reason, becoming an owner, partner, whatever, is just ask a couple questions. Like number one, the difference is like, hey, is there a specific policy that is dedicated to my industry? Right? Like because when you look at a local bank, small town, whatever it is, one branch, I don't know however many million they have in deposits on hand, whatever it may or may not be, but that bank probably does what, one a year, right? So do they have, or have they taken the time and energy to write a dental or veterinarian or whatever it might be specific policy that caters to that industry? Like I was just talking about, the decades of experience knowing the risk of those industries, where then the policies and the procedures and the closing and the parameters and what we call covenants exist or don't exist because they have experience with that, right? So like think about a dentist, like, hey, yeah, I do one implant a year. So if I'm a patient and I'm sitting with that dentist and like, oh, I'll do that implant. Well, yeah, I mean, you believe that, hey, you're a dentist, you could do implants because you said you can, right? Hey, you're a bank, you lend money because you say you can to me because I'm a dentist, right?
Right.
But in the background, well, do they have the procedures? Do they have the ability? Do they have the technology? Do they have the expertise to do that procedure efficiently and cleanly because they do it all the time? Or is the patient, not gonna, they're like, why they're fumbling around? Like, is this taking too long or not? Like, there's no perspective because the patient's
Right.
just in the chair. So that's kind of a good analogy for like a bank that knows what they're doing because they have a policy and people dedicated to it, versus a bank that, the regular banker who also does manufacturing lending, who also does restaurant lending. Oh yeah, I do dental, right? Yeah, we could do that, right? Well, can they really, right? Do they have the expertise? So
I,
so
I agree.
asking, yeah, so asking like, hey, do you have a specific policy? Do you have a fulfillment team? Do you have an underwriting team that's dedicated just to this? Because again, you're going to get a seamless process, a more fluid, better experience, better product in the end, versus the local regional one that might just do the one-offs, right? Um,
Correct.
like, hey, yeah, we've done healthcare lending. Okay, but do you do healthcare lending? right? Is kind of an easy way to say it. But that's kind of it in a nutshell. And that goes back to the first question, right? Like the evolution. So the doctor that's owned the practice for 20, 30 years, when they got that practice, lending was way different than
Right.
what it is today. And so those sellers who like, oh, I just got a loan. My local bank just helped me buy that practice or whatever, or I did it by myself. Today they may not understand, like, no, you have to go back and look at the historical financials of your practice to make sure it cash flows to substantiate the price. And that's kind of your job when it comes to talking them through, like, no, we have to show that it cash flows on paper, right?
Right.
So
Yeah. No, absolutely. Okay, so the other question I have for you is it gets brought up all the time. I know that there's a place for it, but it seems to me once again that it goes to me, I guess, with my transition experience, it goes in waves. But the big three letters that you hear, SBA, they're coming up often again. Uh, just so people understand, I'm not a fan of them. They have their time and place, but I'm not. I think that there's sometimes they get brought up and sold very hard to some people, and so when is the right time, or what's the right place for an SBA loan to be used versus a conventional loan?
sure. No, I mean, I get into this all the time too. So it's wise to just understand the differences, right? And to educate yourself. So in general, right, just kind of talk about SBA, Small Business Administration, that program exists to support any small business across all industries, basically, right? So again, manufacturing, a restaurant, auto body shop, engineering, whatever. If you want to start or buy a business, SBA is built to help people be able to do that because it's a government-backed program, and basically you have to follow those parameters. So it's universal across all banks, basically, because there's standard operating procedures that every bank has to follow. And again, it's there to help anybody who wants to be a business owner to support the economy, right? But it's government backed. So with something that's government backed, which basically means to anybody who doesn't understand that, is that if a bank does an SBA loan for a restaurant and they follow all procedures, and that loan ends up going bad because of whatever reason, the restaurant closes, doesn't do well, um, a certain percentage of that loan is backed by the government. So the bank's risk goes down because their losses are covered. And it could be all the loan, it could be a portion of the loan, it depends, right? But the basics is SBA exists because the bank can take additional risk to helping people create businesses or buy businesses to support small business across the country, to support employment, et cetera, with less risk to the bank. Okay, so that's what basically the nature of SBA loan is. Now with that, there's fees and there's red tape, and you have to follow things because again, it's universal. So when somebody, then going back to kind of the evolution of banking, um, when somebody is in one of these healthcare industries and they and they qualify for a conventional in-house portfolio practice loan, there's a reason why those exist, because they're typically better. The terms are better, less fees, less red tape. So, again, there are times and places for SBA loans, and I just encourage anybody to make sure if you hear SBA, ask why, right? Like, why do I have to do SBA? Why can't I go conventional? Like when you're buying a house, FHA loans exist, Federal
Yep.
Housing Administration, and there's conventional. Everybody knows because houses transact all the time. Hey, an FHA loan has less down, but then you pay primary mortgage insurance.
Yep.
It's a great program for people who don't have a down payment to buy a house.
Right.
But if you have enough to down to buy your house, don't pay PMI. Don't pay the fees. Do a conventional loan,
Yep.
right? And it's the same thing with healthcare lending, but people just aren't aware of the nature of the industry's banking and lending programs. So again, like SBA exists because you can use projections, right? SBA uses projections because then you can substantiate the risk you're doing because you're helping the doctor expand or grow. Even though they don't make enough today to afford the loan, you know they're adding an op or two where they will afford the loan tomorrow, and it's backed by the government, so therefore the bank can make the stretch.
Mm-hmm.
That's a reason why you should do an SBA loan if you need that. But again, conventional loans, generally speaking, have better terms and
So
less red tape.
so when you get into an SBA loan, is there just for someone that maybe in one right now and stuff? I know a lot of times they don't read always the whole contract and stuff. Anything for the buyers out there that, I mean, can you pay it off early? Is there prepayment penalties? Can you get out of that? Can you refinance a SBA loan into a conventional loan after a few years and stuff like that? Or because it's a government funded thing, is there the rules don't allow for that kind of stuff?
So the answer to those questions are, well, of course, yes, you can refinance it, but it depends, right? There's two different types of SBA loans. There's something called a 7A loan. Those 7A loans have a 3-year prepayment penalty. So if you did the SBA loan with the last 3 years, you shouldn't have one. Or I'm saying if you did it within the last 3 years, you may have one. After 3 years, you should be clear. And then there's something called a 504 loan. A 504 loan is a different loan, but basically there's a second mortgage or a second loan, and that's a bond. It's called a debenture. It's a bond that has a 10-year prepayment penalty, because it's a bond, right?
Right,
It's a government-backed bond, and so the investors who buy that bond need to make that money, right? Because it's a
right.
guaranteed rate of return. So that loan you have to be a little more careful with, and there's more parameters around it because of the bond. But in like SBA loans also, depending on the bank that originates them, may have a variable rate, may only have a fixed rate for 5 years. It could be fully fixed, fully amortized. So again, anybody who's an SBA loan and the prime rate and the federal funds rate has gone up significantly over the last 2 years.
Yep.
Those, if they were in a variable rate loan, you're going to see SBA loans really go up. I just helped somebody refinance out of their SBA loan because they bought the practice 8 years or 7 years ago, whatever. Didn't realize there was practice lenders, so they went to their local bank who used an SBA loan to buy the real estate and buy the practice, and their rate was 10 point something, right? And so we refinanced them, into significantly lower rates, because that rate had gone up significantly over the last 2 years. So
So I
that's
was just going to
yeah.
say, speaking of that, that is something I think that gets missed a lot too. Is once again, you fall into that loan, you get into your monthly payments, and you're not paying attention to once again the contract and stuff. How much do you see right now that anybody listening should be looking at if they've had their loan for 10, 15 years, should be looking, especially if they have an SBA, should be looking at refinancing because of those balloon payments and different things going, probably paying way more than what they should be.
Yeah, and my advice is to, just like you probably watch your home mortgage, right? You knew, hey, I know what my rate is on my home mortgage, and or hopefully you watch that. Is to do the same thing. Just watch the market. Again, talk to a practice lender. Local bank may not have the ability to refinance if they don't have a healthcare lending program. And if you're in a loan, that you did however many years ago, just watch where rates go, right? I mean, just like your house. So it's always wise to have a financial advisor or a CPA, or yourself, right? Just be aware of market conditions and know where the rate environment went. The fact of the matter is that rates 2 years ago were significantly lower than what they were today, what they are today, by maybe 4%.
Right.
So if you didn't refinance in 2021 or 2022, right, you may have missed the boat. But if you're in a loan though that was pegged to the prime rate or the federal funds rate, those loans still have gone up, and there's still opportunities for you to help yourself financially. And just know that a practice loan, just like your home mortgage, because there isn't the fees and the rigmarole with an SBA loan, if rates go down after a few years, because there's prepayment penalties in practice loans too, but you always have the ability to at least watch it and to better yourself financially. And I mean, well, I won't even get into the fact that every practice every few years probably needs additional financing for upgrading technology, refreshing their office, whatever it might be. So
Mm-hmm.
just having a relationship with a lender or bank that you can reach out to because they have a program and they're there to service you, and talk you through to retain your business. It's just smart financially to just keep your debt payments as low as they can be, so you can just go back to your chair and focus on what you do best, which
Right.
is practicing whatever your specialty, whatever your trade is. Because that's the one thing about owner operator private practices. You make money by being in the chair with patients,
Right.
not watching where your loans go.
Right.
But if you don't watch where your loans go because you are the entrepreneur as well, then you might lose money because you didn't pay attention to where rates were. So
Right.
like you gotta, and you gotta watch both because you're an entrepreneur and a doctor. So
Well, I just know, like with our business ownership coaching and stuff, that's one of those things that, we bring into, there's certain checklists, right? That you got to make sure that you're paying attention to on, it doesn't have to be a weekly basis, stuff like that. But, there's that once a month, there's that every quarter, there's every 6 month type checklist of things that you should be paying attention to. And that's one of them, especially depending on what you got into. But, if we ever get back to interest, people that are buying now at what, 7% around that range,
yeah,
and in,
sixes, sevens, yeah. I mean,
you know,
depends on the bank, right? But yeah,
right.
yeah,
So in 3 years, if we were 3, 4 years to go back down to the 3% again, and you're not paying attention to that, you're missing out on a tremendous amount of money to refinance, for that at 4%. So,
and I hope we never go back down that low again, because that means something economically happened to cause that and trigger the rates going down that far. But I mean, historically speaking, yeah. Well, again, you just want to be smart with your money, right? You have
right,
a financial advisor to manage your wealth. You have a financial advisor to manage your 401k or whatever. Um, have a financial institution that you can reach out to and just ask some questions, because
right,
you can ask that. I mean, do you need to do it quarterly? No, but watch the market.
right.
Like CNBC, whatever. I mean, again, doctors are business owners. There's a lot riding on their success for that business. Just be aware of market conditions, but you don't need to, don't need to read about it weekly, but maybe monthly, quarterly, biannually, whatever. So,
Yeah,
or
no doubt
semi-annual,
about it.
not biannual. Yeah.
So I've I've heard you go back and forth, and I know we've in other podcasts that we've talked about this, but let's get your opinion, because I hear you go back and forth of lender banker.
Yeah.
What is, when choosing, what's the difference? Lender banker, and
Yeah.
who supports what, and better or worse or whatever, you know what I mean?
Yeah. Well, so it's funny. Like, I always don't really consider myself a banker, right? Because in my head, a banker, helps day to day. They manage your deposit accounts. Um, they, oh, I need to put a stop payment on that check. You call your banker, right? um, a lending specialist, helps you with that situation, right? So like how Panacea works, and Wells Fargo works the same way, and some of the B of A works the same way, where you have these lending specialists, I'll say, just for lack of, there's other terms we use to call ourselves, but we guide people through the process of getting approved for a loan, what they need to provide, give them advice on how to do it, maybe, um, look at the cash flow. And then once we complete that transaction, we all have like an actual business banker or personal bankers that then support the doctor with quote unquote day-to-day banking, right? Like think of your home mortgage person. When you do a home mortgage, does that person help you with your personal banking after you do your mortgage? No, right? So
Right,
a home
right,
mortgage person is a home mortgage consultant or a home mortgage lender. So that's kind of what I relate to, because I feel like my job is to be the specialist to help them through the transaction. And then Panacea, as an example, we have business bankers and personal bankers that then will help people with their day to day. Do we go away? No. Like, your lender should always be there. You should always be able to text them, call them if you have a question. But we did our specialty job. Now it's time to hand them off to the next specialist that then, hey, you want to talk about treasury management, you want to talk about credit card processing, you want to talk about the deposit that didn't go through, or that someone got a hold of your information, you need to cancel, put a stop payments and stuff, right? That's what I call a banker. But whatever it is that you might be, again, just have a specialist that understands the situation. And that kind of goes back to maybe local banks, regional banks versus a practice bank. Like I've gotten calls from people where the local bank is doing the loan to help them with like the expansion, and then they call me saying,
Right.
hey, actually I need to do an equipment loan. Well, why do you need to do an equipment loan? Well, I ran out of money with my other approval. Well, how did you run out of money with the other approval? Then, well, my local bank didn't approve me for enough. Like, okay, well, why didn't they approve you for enough? Did they not understand that you need X amount? Well, yeah, but they didn't. Like, okay, well, seeing around the corner to be
Right.
able to predict what a doctor needs on a project or on an acquisition or whatever it may be, that's again, we're specialists and experts in the industry. I just encourage people to talk to them, because whatever your practice might need in the future, you want to have someone that has great experience. Again, just like an implant, right? Like, don't, like, if someone doesn't do implants every day and you need an implant, and that doctor decides to take that case on, what's the likelihood of it going as smooth or not? I don't know, right? Like that's why specialists exist, right? You go to them for that problem.
Yeah, I think the other thing is important for anybody that's listening is also, though, when it comes to lenders, I think it is important to interview your lender a little bit, because I will tell you, depending on the bank, and sometimes not the bank, the person. You mentioned a good thing, because one of the things that I hear a lot is, well, I was told to go to a bank because they'll follow me, right? And I'll always have someone to talk to. And I always tell them, that I can see where that's true. Where your banker is your lender. There's some banks out there that have a national healthcare lending um, setup the local banker can do. Uh, but I do think that, once again, that's the relationship part of the thing, of the deal of the transition, that sometimes gets lost, because of maybe the banks out there that maybe have a bigger presence. But once again, I always say a lender is a lender can be good and they can be bad, depending on what kind of relationship that they want to have with their person. So, for example, I've had several opportunities to work with you, and you're all in on your customer, versus I know that I have buyers, or I have uh, buyers that have had a practice for a while and say, yeah, once I got the loan, never heard from them again, never heard from her again. So I think that is important. Interview a little bit, to make sure that you see what you're getting, because I do think
Mhm.
that, even though you're a lender and you're going to pass the day-to-day stuff off, I still feel like that lender needs to be able to have uh, something where there's that relationship a little bit, to know that, okay, in 5 years I bought this practice, but in 5 years I want to take it to the next level,
Mhm.
that they know who to go back to. And it's not one of those things where, I think, like the thing that you described is exactly that problem is they work with somebody, they got passed off, they've never heard from them again. And so what what do I switch to? Well, I just, so and so and so and so said that they got their loans through First State Bank, so I'm just going to go to the local bank, and do it. And it's like, no, if you would have, that relationship, go back to that person and let them take care of it, because I agree with you 100%. You get snagged in some of those so bad. We're doing a rebuild project right now, and that's exactly what's happened. The
Mhm.
bank only was doing so much, and now it's like, okay, but we still have $150,000 of equipment, and now you got to find a bank that's willing to do that loan without wanting the first lien on everything, right? And
Mhm.
so you're scrambling for $150,000. So
Yeah.
that's just my 2 cents on that.
Yeah, no, and you're right, and it's again, like anybody who's a practice owner or aspiring to be a practice owner, is just educate yourself, right? Educate yourself on how the programs work, every lending institution, every bank, does things their own way. But there's universal kind of just parameters that we all kind of watch, and we all kind of abide by, and then you get some differences in different programs. And if you're buying a practice or starting a practice, or you have a practice and you need something in the future, hey, I like to have, like, just like, hey, I bought this house, but I know it's a fixer upper and I know we want to have 5 kids and it's a 2 bedroom. Well, you're going to need more bedrooms, right? So
Right.
if you're aspiring to be a doctor that wants to have multiple associates, you're getting a bigger space in the future, and that's where you want to go. Educate yourself on how that might look today for your practice, and just encourage yourself to understand the future and how those programs work today and how they might work tomorrow. So then you make a good decision, because unlike your mortgage on your house, when you do a loan with a practice lender, to switch and go to another lender because they don't do what you're trying to do, like you said, you can only do typically things with one bank. You can't have multiple liens on a practice. Unlike a house, I could do my mortgage with Wells Fargo and I could do my equity line with Bank of America, and they'll play fine because there's a first mortgage, second mortgage, right? Well,
Right.
that's not how practice lending works, unfortunately. So just educate yourself and look past the loan. Um, Look past what you're doing today and what you might be doing tomorrow. Look at the other strings attached to that loan. Do I have to bank with that bank? What is the banking program? What are the fees associated with that? What are the pros and cons? Just because you're doing something for your livelihood and your profession and your family and your career, and just have a financial partner that will help you in the future, and just understand that.
Yeah.
And that, hey, if all you need is a loan and that's all you're ever going to do, good. You know what your options are, and you know what you could do there. But if you have plans for expansion and growth, just educate yourself. Do it today, because you might pay for it tomorrow if you don't educate yourself today.
Yep. I agree 100%. Well, actually, Rob, that was a pretty good recap of some things and stuff too. So that was, I really appreciate it. We could go on and on with this whole situation. So, but I really want to thank you for being here today and for giving us a history lesson a little bit and information that definitely can, well, hopefully people, like you said, will do their investigation, their research, and be able to make some really, really good decisions, not for just the now, but also for the future. So, thanks once again for coming on and helping us educate ourselves.
What it's about, right? Just educating people and helping them make good decisions for whatever they're doing, right? Just like you, and you're trying to help somebody sell their practice, and they have a business broker that does one dental deal a year. Like, there's some differences with your expertise, right? So
Yep,
that's what we're all here, is pay it forward. So I thank
I
you for
agree.
having me, Phil, and yeah, you guys do a wonderful job, and just appreciate being invited.
Oh, no problem. So, as always, if you enjoyed our show, please rate, review us on Apple, Spotify, wherever you get the podcasts. Once again, thanks again for Rob from Panacea Financial for coming on and giving us this information. I'm your host, Phil Cole, and thank you for listening. Everyone, have a good one.